Good morning, everyone, and welcome to the Ankerstar Wealth Morning Show. I'm your host, Allison Ankerstar, and today we'll be talking about Disney's earnings from last night, Pepsi's earnings from this morning, and how you can draw money out of your Roth IRA early. But before we begin, as a reminder, this is a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. Disney's Bob Iger returned as CEO and had his first earnings report yesterday. How did things go for Disney?
Well, good morning, Allison. Good morning, everybody. I think, yesterday was kind of an off day in the market, right? A lot of selling, boo, right? That's not good. But right after the bell, the much anticipated Disney earnings were out and they were good, right? As you know, some of the drama with, well, there's the headline, Bob Iger's on CNBC right now. With him returning as the CEO, that was kind of a big deal last quarter. And they've decided to take the company and kind of split it up into three different versions or sleeves, if you will. There's still no talk of spinning off ESPN, even though there's been folks that have said that would certainly be the way to go. But they're not doing that so far, but they are talking about it as a separate entity within Disney as well. And then you also have parks and the theme parks and stuff that is out there. So overall, I think the share price popped 6%. And people think, okay, well, even though the potential recession's coming, Disney's going to survive this and go off to new highs, if you will. So you can see the article there when you read it. Let's take a look at the stock. I used to be a Disney investor quite a bit, but got out of it going into COVID and really haven't returned. Just because of the ESPN factor. I think it'll be a much better company when they split it off. But here's a 1-year chart. You can see it bottomed right at the end of the year, kind of with everything else, and then it's had a decent move from mid 80s up to 119 this morning already. So overall, it's a great American brand. Has a lot of pricing power. They cut their dividend back in COVID and haven't returned to it since. And then you could argue, well, the PEs may be a little bit expensive. But all in all, I think Bob Iger at the helm adds a lot of stability there. And Disney's starting to do the things it takes to kind of reinvent itself. So not really getting a lot of money from me, or in the book right now for Disney, but I do like what I'm seeing out there. And I think, again, if they would actually go through a split and spin off ESPN, it'd be a lot more attractive for an investment.
Next, Pepsi is one of several stocks that can be considered recession-proof. What does that mean, and is Pepsi a good investment?
Yeah, so that's one of those things when you look at, we had the big rate hike cycle last year, and maybe we're done, maybe we have one more. We'll have to kind of wait and see. But when you look at the rate hikes, money becoming more expensive is really all that's going on. You're looking at the economy slowing down as a result of that. Whether we go into a recession or not, we don't know. We'll find out later this year. But when you look at that, from an investment perspective, you have to think, okay, what are some recession-proof stocks? I like to think in terms, and that's how I have the book positioned, in terms of cybersecurity. People aren't going to cut back on cybersecurity spending just because there's a recession. Cloud computing is another one. Theme that I have. So I have themes in place for the book, but one thing that does come out there, I'm not a Pepsi investor, but I do like what I'm seeing again here from Pepsi. And this is, when you think of like Pepsi, Walmart, Costco, kind of the big American brands that have that power. The people drink Pepsi aren't going to stop drinking Pepsi just because they either got laid off or there's a recession, right? So it does kind of headline the recession-proof mentality out there if you were going to go into an individual name. As far as the overall earnings, they beat earnings, a little bit of a miss on revenue, but the stock is obviously moving up off of that. And the here's get the 1-year chart. you can see, Pepsi really, when you look at last year, it's one of the few names that we finished up, and then it's kind of sold off this year. So it's the inverse tech, right? It's the name, it's a safe name where tech was out of favor last year. So money was flowing out of tech into Pepsi, or like I like to say, cheese with Kraft Heinz, and toothpaste with Procter and Gamble. Those things are benefiting from the sell off in tech. However, as you can see, when the money flows back into tech like it has this year, you can see actually, Pepsi here is down from 176 to 171 or so. And again, it's getting almost all of that back so far today with the move up this morning pre-market. Overall, is it cheap? You bet. P around 24. You do get a little bit of a dividend while you wait. It's not my cup of tea for really investing, because you don't have that long-term year over year best of breed type of return, but it's a safe place to put some money, I think, especially if you think a big recession is coming.
Last, how can people get money back out of their Roth IRAs early?
Well, there's the how to, which is what you're asking, and then there's the should you. So let's talk some theory first. Again, this is Investopedia Roth IRA basics. We'll kind of leave that up there while I talk about it for just a second. So there's your two flavors of IRA / 401k, right? There's a traditional where you get the tax break up front, and then later on you'll face the required minimum distribution and have to take the money back out later, and then you pay taxes on it later. And in those cases, you can be deferring the taxes on something for 4, 5, 6 decades, right? So a long time. The Roth version, whether it's Roth IRA or Roth 401k, is the opposite extreme of I'm happy to pay taxes now to put this money under a Roth hat, and then it grows tax-free forever. So obviously, if you're paying the bill up front and the money can grow for the rest of your life tax-free, then that is the last bucket of money you should want to touch. Your situation may vary, right? But in general, that's the last type of, last bucket of money you want to touch, to the point where I've often said to folks, it's like most people will actually pass away without ever touching their Roth IRAs, right? Because you'd want to bring the entire traditional IRA down first, generally, before touching it. And most people don't exhaust that traditional IRA, right? Because you keep enough net worth in case you live forever. So even if you're 80, say you're 85, you still, having a good old $500,000 in the bank to make sure that you can, pay for yourself for the next decade, or 15 years in case you live to be 100. Most people aren't touching the Roth IRAs. But that's not the question that Allison asked, and that's not the question I've had from some clients, is can you withdraw from your Roth IRA early? Well, the normal, if you get down to this first paragraph here, I'll just highlight one line, and you can see there in blue, the normal age is 59 and a half. And you're like, well, what if, and there's some folks out there looking to retire early, say your goal is age 51. And what can you do if you're age 51 and you've retired, but yet you've done a lifelong savings into your IRAs, 401ks? It's like, how can I get that money? Because I'm not 59 and a half. Those commonly called the gap years. And that's a good problem to have, right? Because you're financially sufficient enough to retire prior to the 59 and a half point, but now you need to live off that money, and you can't get access to it, right? So the Roth has a rule called the 5-year rule. And it's this, so you can sit, as long as the account's been open for 5 years, then you can actually go in and withdraw the capital that you put in. So think about that for a second. So over the course of, say, a decade, and it was a decade ago, right? So say from 2010 to 2020, you put in $5,000 a year, just to keep the math easy. So $5,000 a year for 10 years, that's $50,000. And now your account's sitting there at $110,000, right? So you could reach into your Roth IRA and take out up to the $50,000 that was your own money that you put into it. So again, it's a little bit of shooting yourself in the foot because of the tax deferred growth, but sometimes you're in a square corner. I faced this right when I retired and I started my own business, and I didn't take a salary for 2 years. I needed money to live off for the family and I. for a couple years there. So Roth money was one of the buckets that I was able to tap into to be able to get some cash flow to get through that phase. So again, the rule is if you're over 59 and a half, you can take it out. Doesn't matter. You don't have to worry about the math anymore. But if you do take out below 59 and a half, you can take up to the amount that you put in, over your lifetime. And when you go to file your taxes, it very clearly identifies that amount. So you can, if you take, say, you have that 50,000 total, you take 25,000 this year, 25,000 next year. It annotates that so you know what you've taken out against that capital. So a little bit of a trick. Talk to a CPA if you need to, or a financial planner like myself if you're going to kind of pull that trigger. But there are options again to get that money out of the Roth IRA before you hit the magic 59 and a half date.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's the way of today's show. I'm Allison Ankerstar, and we'll see you back here tomorrow.